Billionaire investor Howard Marks raises his concern that the stock market is overvalued and may be due a correction. In this video, we give you all of the content of Howard's remarks without any of the filler. Let's get into it. Don't forget to like, comment, and subscribe. First, Howard discusses why asset prices are so high given the negative economy and economic outlook.
I'm glad to be with you this morning. Of course, as the quote you just put on the screen indicates, this is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen. Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
Howard talks about the last time he has seen this scenario.
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks. And, the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet. Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive. They may go on to become more expensive, but the fact that they're expensive, it should not be lost.
Howard says we shouldn't be concerned about tech stocks, but about the rest of the S&P 500.
Tech contributes to the aura that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet, have been contributing disproportionately to the rise. And they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued. Not as highly as the Magnificent Seven, but nobody says they're the same quality company. Quite highly valued relative to history, and it is the fact that high valuations are being applied to more average companies that I think's more alarming than the fact that exceptional valuations are being applied to exceptional companies.
Next, Howard discusses whether there is value in the credit market.
it's as John Stuart Mill said in, I believe it was 1859. You have to know all the sides of the story to understand whether your side holds water. Um, and I cite the bull case there for why the market isn't overvalued. I think that's part of the job. But as you say, my conclusion is that I'm not, as I said before, I'm not raising an alarm bell, but I do think it's time for some caution. And uh, this is a little bit of what we call on Wall Street talking your own book. But what I do, what Oaktree does, is mostly something called credit, buying the debts of companies, and debt is inherently more defensive than equities. And you have a promise of payment. You know what your return will be if they pay interest and principal as promised, and most of the time they do. So I just think that this is a time to put a little more defense into your portfolio, and investing in credit as opposed to equities is one way to do it. Well, first of all, Lisa, what see, debt or fixed income or bonds or what I call credit, all different words for the same thing, is different in nature from equities because you do have a promised contractual rate of return. And you can say that the promised contractual return isn't as high as it has been historically, or the increment that it provides over treasuries to compensate for the credit risk isn't as high as it has been historically. But you can't say that they don't promise 7.5%. And a promise of 7.5%, you're going to pay some fees. You're once in a while going to encounter a credit loss. I think it's highly likely to provide, let's say, a return in the sixes over the next 10 years. A contractual guarantee approaching something in the sixes over the next 10 years is, I think, more defensive than being in the stock market at these elevated valuations. That's the point. And you just said tighter than they have been since '98. And if you looked at where they were in '98, and you hypothesized to put an investment in a portfolio of high yield bonds in '98, how did you do over the last 17 years, 27 years? And I think you did fine. That's my point. It has a high probability of doing fine, whereas stocks, if the valuations are elevated, have some reasonable probability of doing less than fine.
Marx answers whether the United States is still the driving force behind the world's finance markets.
I think I said in the memo that I think the U.S. is still the best place in the world to invest. The things that make the U.S. exceptional, the spirit of innovation, the free markets, the rule of law, the capital markets, the growth and dynamism, the great companies, these things are still all true. But as I said in the memo, we're the best place. We may be a little less best than we used to be. The world is thinking that maybe the U.S. is a little less best than it used to be, and I can't argue against that. I mean, fundamentally, as an investment environment, I think things are a little bit deteriorated.
Finally, Howard lets us know if there are other areas of the world that are more appealing.
Well, as I say, I still think we're the best place in the world to invest. And you know, we're a great car at a high price. You can get some cars around the world that are not as great as ours, cheaper. Which do you prefer? Less good at a cheaper price or better at a more expensive price. So, you know, other parts of the world do not have our dynamism. And lots of places in the world are overregulated compared to the United States. But if they're on sale relative to the U.S., it's not unreasonable to want to have some representation there.
What did you think of Howard's remarks? Are there any other investors you'd like us to showcase? Let us know in the comments. Don't forget to like, comment, and subscribe.